The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Folks, Basil Chapman, Tiger Technicians Hour. Very interesting day coming up. This is going to be a special day. Why? Because the Fed is possibly about to make an announcement that might change the course of interest rates. However, as I was reminded by one of our Tigers, a comment that I have made for a very long time is that the Fed announcements, and this goes right back, way back to when back in the 70s, when I used to always listen for, on a Thursday, it was M1, the money supply. Then later on, it was the M2, a deeper analysis and configuration of the money supply. And then it was M3. M3 is the total money supply. And we were waiting for that. Then it was bonds. What were bonds? And then all of a sudden, you get the Fed speak. And basically what happens is that trends don't really change. Once in a while, they will change right at that very moment when the market is either at a top or at a bottom with a Fed announcement. But most of the time, a trend that is in place will stay in place, even if just kind of a brief pause in a different direction takes place. In the Dow and the E-minis, and the S&P, I'm still on a daily sell mode. There could be a bounce, and what would happen is the E-minis I'm showing here down 575 at 2060. The the W-shaped pattern, soft W is two U's put together, lowercase U's, and the letter U, that is. If you're looking at that, there's a lot of resistance at the 200-period moving average of 2066. But you'll find the same thing. Gosh, I wonder if that's been updated. Dow. So that'll be E, A, B, C. Okay, so let's just do this. We've got E right there. And then you're going to get an up arrow. Is it not an up arrow? No, it has to be a plus sign right there. We don't really have up in the 80% area for the stochastic. And lo and behold, you've got the, let me just do this right here. Why is it not? There it is. A, B, C. Usually when you get to C, I've already put the up arrow. It doesn't matter. Okay, let me show you something. In the 120-minute Dow chart, what we're looking at here is a peak C starting to pull back, and it's very visual. I'm very visual. That's my whole thing, is the visual aspect. Yes, there's the mathematical part and the arithmetic part, but actually it's more the patterns. I love looking at these patterns. And look at this pattern right here. It says that the Dow is fighting two particular patterns in the 120-minute chart. There's the Chapman wave, falling axe, inverted falling axe. Normally, I would have had an up channel right here like I do in the daily, right there. You see that up channel is what I show my subscribers every day. And we've taken that out. So that, in a sense, says you've negated that uptrend line, which is part of an up channel, and you can open it out and say to the low of the day, if we take out that low by the end of the day, because there's disappointment in whatever is going on, it says that there's a real good chance you're going to make the H, lowercase h pattern. That's this one here. Let me just draw it in here. Looks like that. And then it goes, you've got a sloping back. Sometimes it's straight, but usually it's sloping. And then you've got this pattern, lowercase h. And if the left side of that is taken out, in other words, 17,620 in the Dow, in the next few days, that is a negative, and it says that the arch formation is continuing and that we should be prepared to look at it this way. That there's a left side, right side price time match, and that time match should, in fact, take the Dow back to the 17,034, so the 17,000 millennium level, for a test of that sometime by, I'll do this here, right there, red. So this is green, and this is red. And that should take you to where and when? By the end of the month, the 30th of March, the Dow should be testing 17,034. That's if we take that out. This is a Chapman Wave Roman candle right here. That also says that if the price of the Dow is going to go to 17,700, there's a real good chance you're going to test the 17,620 level based on this particular candle. On the other side of the coin, the 200-period moving average of 17,865. Now, this is going to go to this, wasn't a question, it was more a statement. In fact, it was a very interesting thing. Let me just read it to you. Kevin sent, there it is. Kevin sent, bull or bear? Come on, Basil, stop being so boring. Are you a bull or a bear short term? What happened to the Fed doesn't change market direction, but you keep bringing them up on the radio? And then he actually adds a little compliment after that, but Kevin keeps me on track. That's okay. Let me explain this, Kevin. We're in a sell mode in the Dow. We've done our business in terms of preparing for that. That's number one. Number two is that within the context of what we're looking at, my contention is that if the Fed does something, whatever it is, that something will have an impact, but it is the price of the market. In other words, the Dow now, here comes the other side of the coin. And the reason why I always set these if this and if that up is because I'm not the market. I'm merely doing the very best I can in giving you a GPS, trying to follow where we are and what we're doing and which direction we're going with its various, the myriad of techniques that I have. And all I can say is this, that I'm kind of watching really closely the dissing of the VIX that the market is giving it right now. The VIX is only at 15.58. It's actually down on the day. When the Dow's down 77 at 17,771, the S&P is down 6 at 2,068. The comp index is right now, let me just dig into that. So the comp index is right there. The comp index is down 6 at 49.31. Gold. Now, this is going to be really interesting. I want to put the whole package together. Gold is down 40 cents at 11.47. Silver is down 0.09 at 15.48. Platinum is down 6 at 10.89. High-grade copper is down at 2.58, down 5.80. Crude oil is down 98 cents, down at 44.20. Bonds are up 27.30 seconds. Boy, this is just a wonderful picture that I can paint right now. And I'm watching real closely to see how we're doing for time. But in the meantime, back at the ranch, this is the real picture. That if the Dow at 2:35, that's 2 o'clock comes the announcement. 2:30 is Yellen's discussion for the press, and at about 2:35, and I'm sorry to my subscribers, I was so busy getting out all the information, gave you that 16-page report. It should be emailed to you. I thought it was on your desktop, but you should have it already, and there shouldn't be a problem with that. And but in doing all my stuff, for some reason, I forgot to read number 3. I don't really want to do an update today. All I can say is I usually find that whatever update I give, the very next day I could have done it even better. So I don't care. There's no trade in number 3. It doesn't matter. We're all prepared based on number 12 in the Trader's Corner. So we got just a few seconds left. Let me tell you this. The other side of the coin is, for any reason, if the Dow goes over 17,900, It's actually 17,990 that I'm looking at. But I'm even prepared to say that if it goes above 17,900 between today and tomorrow, that's going to suggest that I might have to rethink the whole aspect of the sell mode. I might have to change that in the Dow. But those are the parameters I'm looking at. And if you look at the weekly chart, let me get rid of this 120-minute chart. Look at the weekly chart. The weekly chart is the 9-period moving average. It's under it. We're going to a break right now. Basil Chapman, Tiger Technicians Hour. I'm going to be looking why at the dollar and the currencies. I'm going to be looking at gold, and I'll explain something when we get back that I think will be very interesting. Going to a break right now.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. Everbank is a member FDIC and equal housing lender.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Folks, we're back, I believe, and I'm just waiting for my, there's my, I'm on, that's it. Just a little kind of technical stuff going on here. Kind of tripped over my ear set, and I don't know what I did with the microphone, so we've got our backup here. Look at the dollar, sitting there so beautifully. It's at 99.64, up 5 cents. Now, I discussed this yesterday, and I said, we will know by this afternoon, that's Wednesday afternoon, whether or not the Fed is going to, I'm wondering if the Fed isn't going to, things come out of the blue. You never know where it's going to come from. What if the Fed does something that impacts the dollar negatively? What would be the beneficiary? What areas would be the beneficiary? So far, the technicals of the dollar look fabulous. It's going to have to come from something else that's going to knock it down. It's trading at 99.64. 98.91 is the 9-period moving average. For the first time, I've got that little red line going above. It says this is where you've got to be a little bit careful. 98.19 is the first real support after 98.91. And then you get 97.38 area. Now, the weekly chart is very strong, 96% in the stochastic, way stronger even than the daily. And the monthly has just begun flattening out. The month, I'm not sure what, only governments can do this. No banks, no big funds. There's no way. The only way you're going to knock the monthly dollar index down to get the stochastic from 97% down to 87% is for it to plunge into the 93 to 90 area, and it has to do it very quickly or gradually over a period of time. Okay. With that said, most importantly, what I'm looking at is that on a short-term basis, you got your peak F in the dollar as it ran up at 3:15 in the afternoon on the 13th of February. But then look what happened. It came back down, and so far this up-channel line on the inside track right there is holding quite well. Let's do this. Let's look at the Euro, EUR, USD currency pair. Try to put that together, and look, the euro is just trying to. The fast-moving average of the MACD is way above where it was just from the early part of February. That's a positive divergence. Stochastic's trying to turn up. It's gone from the, what was it, in the 3% area? Yep, no, 1.8% area. It's now at 11. It's at 11, and it's had the most pathetic little rally. So the Fed this afternoon could be very instrumental in impacting the commodities. And that was, I'm not saying they're going to. I'm saying if there is an impact at all, the first thing that we should see is that the dollar is going to be pulling back, and that the euro, gold, gosh, maybe even crude oil are going to have a bit of a bounce. Now, why do I say a bit of a bounce? Because you have to here go step by step. My inkling is that if the dollar was to pull back, it's going to be a little bit of a barometer, a little thermometer barometer for the Fed to say, hey, I think we're managing this fine as long as the Dow and the S&P don't crack 1.5% to 2% in the next 2 days because of whatever it is. Now, what about the opposite? Well, looking at the VIX, looking at the trend, looking at my sentiment gauges, looking at the Dow 30, I went through all of them. It's going to be a very select rally. It's going to take some of the banks. It's going to take some other areas to push the market up, and I don't know how much they can do to the upside. I just see retesting the old highs is the best. We've got a break coming up. I'm going to be right back. Basil Chapman, Dow's down 93, S&P's down 7. I'll be right back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, oil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. And just to remind me, I got an email to say, talking about the weather. A long time ago, I said that in my 200-year chart in National Geographic, quite a while back, I said that my count in the Chapman wave of that particular chart had us in leg F. And I got a comment by someone who sent to me, just trying to find it here, and discussing, discussing the, there it is. Dan says, hi, Basil, I thought you would find this interesting. Didn't you have a peak F in temperature? Leg F. I didn't have a peak F. Remember, I made a joke about it. I said it's a 200-year chart. But by the time we get a confirmation that it's a peak F, not only will we be talking about going back to the Ice Age, just like we did. You remember, I showed the cover back in the 1970s, the Time magazine cover, the Ice Age, it said. And scientists were 100% sure that they were going to the Ice Age. And I said, gee, I don't know. I've got this chart and it says we're in leg F. In my lifetime, I might not get to see that it's a peak F because it's a 200-year chart. You can take a while to get that confirmation. Anyway, so yes, interesting. And then the article was very interesting. Yes. Fascinating about science. Okay, now let's go back to this. So what I'm saying is that if the Fed, I love this. The Fed are like Penn and Teller, and you've got Penn doing a whole bunch of stuff, and Teller's the other hand doing the other thing, and you're looking, but on the side, the part that you don't see is what's really going on. Same as politicians in the news. When a politician says, I'm not a liar, you've always got to put the opposite side and say, I am a liar. That's just the way it is. All right? So the same thing occurs when we're talking about politicians or people in the Fed. They're really politicians. Or if you're talking about economists, because you have to always assuage someone about your particular point of view. And while you're doing that, you've got to be pointing out certain things. Those might not necessarily be the specific things that are going to change the criteria. That's why we do a technical analysis, because look at this, the technical analysis of crude oil right here says that the stochastics at 7%, it is flat. It is like when the positive is when the stochastics up in the 93, 96, 97% area. It takes a long while for it to keep coming down until it gets under 80%. So here it should take a little while for it to get to the 20% area. So that flat stochastic is saying there's no real energy. I'm going to need some kind of external spark other than the technicals improving gradually to give me that turn, or a V-shaped pattern. I need something to do that. Otherwise, I'm just going to be coming back down here as the stochastic remains in the single digits, right? Look at the 13% in the weekly chart right here. Not good at all. Nothing technically at all. By Friday it could change, but right now it's ugly. Look at the monthly chart of crude oil. So that says to me there is some relationship, not in a direct relationship per se, but there is definitely a relationship that we can conclude going between the way the direction that the dollar trades. I'm not going to just say the way because it could have bumpiness, but it's moving. The trajectory is up. And on the way down, you've got crude oil doing the exact opposite. And that's saying that there is a chance today that if the Fed does something with so much selling, and I had a question about UNG. Let me include the UNG here. UNG is a little different animal because it's got an arch pattern. There I drew it in right there in the weekly chart. Drew it in the monthly chart, that arch pattern, which is making slightly higher lows. It hasn't yet made higher highs, just fractional, but it hasn't gone above the important left side peak of 1524. Now, as I remember, Steve Rhodes had his chart that he was showing about the seasonals. This is about the time in the seasonals that very often natural gas has. So there's a different aspect to it But it is a commodity, and it's been trading very much like a commodity. But what I mentioned to subscribers is that commodities, I'd shown a commodity chart, and it was this chart right here. Am I going to remember it? TRCCI. Yes, correct. And it said that this has all the commodities, the softs, the hards, the liquids, the whatever it is. And look, it's underneath the 200-period moving average. It's broken its major 2001 14-year trend line, uptrend line. And it's closed under it now once, twice, and this is the third month. And that says something now very special has to happen in commodities to be able to take it even from this particular chart of the Thomson Reuters Continuous Commodity Index monthly chart with the Chapman wave notation, to take it from where it is at 407, it's called 408, from 408 into even the trend line right there. Around about near where the 9-period moving average is. No, that's too far. That's at 459, or let's call it 460. So even just to get it above last week's high of 440, let's call it 441, that's 10%. Well, it's going to take something to push the dollar down significantly for the commodities to have anything but a counter-trend rally, because of the power of the dollar, as I see it, reading it in the weekly and the monthly. Now we know that the rudder, which is the little turning signal, comes from the 120-minute chart. It's really the daily that's going to make a big difference. If the daily does make a difference, and it has to make a difference not just in speed, it has to do it in speed, and then it has to do it in time. If the rudder of the commodity index, this is the way I'm looking at it right now, gets to turn, then 414 is the 9-period moving average that it has. It's closed once above it since it broke down back on the 18th of February. This is a daily chart. And that's the way I'm looking at this right now. So when it comes to the Fed, what I'm looking at is, now let's do the bonds, because it's obviously very important right now. The TBT gave the opposite reading when it gave the peak D in the daily chart the other day. Well, now it's not the other day anymore, it's about 2 weeks ago. Right there at 47.54, that's the inversion. That's the ultra-short Lehman 20-plus year T Treasury bond yield fund. And there, those two little bars, bam, it comes underneath it. That's an island reversal at the top. Now you're under the 9-period moving average. The MACD is negative. Stochastic is still very negative. And it's suggesting, based on the chart, not on what Yellen's going to say, that there's a chance that the Fed is really not going to do very much. So it's other things. That's why I'm saying maybe we're going to be looking at the dollar. We're going to be looking elsewhere. Here's my hand. But it's this hand that you got to be watching closely. So it's sleight of hand. That's why they call it sleight of hand. Look at the TLT. TLT has this beautiful island reversal gap. It's making a cup formation. And this corresponds higher, we won't know, of course, by 3 o'clock this afternoon, we could get a 1.5-point move in bonds. It's happened before. And that does happen in Fed news. There's this wild gyration. What I'm saying is the actual trend itself, once the trend is in place, it should stay in place regardless. And that means for me that the sell mode in the key indices that I mentioned, the Dow, the S&P, the New York Stock Exchange, still in sell mode. Their weekly charts this Friday will give me a clue whether I've got a sell signal yet. I haven't even got a sell signal, but let's see what happens. Or whether we've recycled higher. The question is, will the S&P make leg D this period, or is it after a rather severe downturn? That's my big question. So now what I'm looking at, I grab this and I make another cup formation, and I say, okay, keep it as simple as possible. Regardless of what the Fed says, if the TLT closes above 130.38, and right now it's at 129.97, if it closes above there, the resistance levels are all taken out. The next is the gap of 132.25. I'm trying to keep it as simple as possible. If the Fed has an inflection point on the yields, then the yields are going to say, right here, oops, that's the wrong one. Let me get the chart. Just let me get out of this. Close the workspace. And let me go to this chart here. Long-term chart right there. Then the yields are going to say that peak B that was made in the weekly chart right here. Remember, this is my triple yield chart. Let me squash it so you can see how magnificent this is. There's that cluster formation back in June of 2007 at 54.08, 5.48%. Now, some of us remember 13, 14, 15, 16% way back in the early 1980s. But now look at the chart. There's just a general move to the downside, and then it sort of stalls and has a big bump. Here's the big question. Can the tide, the declining tide of yields, which, if those of you remember that for at least the time that you've heard me at TFNN, I've been talking about the Japanization of our bond yields, and now there's an international Japanization of bond yields. How can we be that different? How can we, especially when I believe we're in about the third week of a recession, mini recession right now, could be wrong, but that's my impression of what's going on. How can the yields start to climb? Although higher yields often create the recession, in this particular instance, there's so much pressure internationally. This is commoditization of bond yields. So this is going to be interesting. Keep it simple. I'm wrong. At least short term, if the 30-year in the next week or two goes above 28.70, 2.870, that starts leg C. If it goes to leg C, there's a real good chance it's going to go to a D. And that'll say for the next few weeks at least, we've got bond yields going higher. So now, this is getting it's getting a little complicated, but let me explain something. Very often, when the yields go up, in this particular instance, just very often, I mean over the period of a year or two, when the yields have gone up, it's created a little bit of shakiness and a little unsteadiness in the market, and that might correspond to why we might see a decline now rather than after a rally to test the highs. So these are very complex questions. Make it simple. Yields go above the previous high in the weekly chart of 28.70. Yields are going higher, bonds are going lower. If the 2.57 yield right now starts to decline, bonds are going higher. If yield goes under 2.4, bonds are going higher. Just keep it as simple as you can. And now I know we're coming up to a break. I wanted to show you something in the very long term US. There we go. In the very long term. See, there's that falling axe formation in the bonds and the continuous contract of the 30-year. I didn't read you all the letters because of that big divergence between the outer month and the inner month. But look at this. That weekly chart, I had drawn the arch formation. We're right there. So this is going to be a big test. And we've got a beautiful up channel, but a real testing of strength with that 9-period moving average. It's at 162. If the bonds go under 158, all of a sudden, yields are going to go much higher. Bonds are going to go lower because it's under the 9 EMA. Very interesting. So I'm going to do this right now because I wanted to show you something else. And this, to me, it was a surprise this morning when I saw it. There it is. There is the high-grade copper. And high-grade copper is down, sharply, down 2.34%. I'm not sure what the Fed is going to do for those commodities when copper is just suddenly... Copper is saying that if it continues down like this, I might be correct in saying we're about 2-3 weeks into a mini recession. Wouldn't that be interesting? Now, you won't read anywhere about mini recessions. Why? Because you have to wait months or at least weeks and weeks and weeks before you can look back, because economists look back. They don't look. They're not allowed to look forward. You are assessing previous data and then trying to extrapolate. From that, you can extrapolate. But the data comes out late, and then you've got to extrapolate. We're trying to look ahead. So I might be wrong, but that's kind of my thinking. That's what I wrote in my big report, a report that should have been emailed to all my subscribers and the trial subscribers. I think we're about to go to a break, and I'm waiting for my engineer, Al, to tell me. I don't want to talk through the break, which I often do. But let's see. Yep, we got a break. I didn't even hear him. Can't hear a word. Can't hear the music. I'm open sourcing here, but I think we're going to a break. Oops, not going to a break yet. I'll just keep stalling because not yet. All right, not yet. So if the copper goes under 2.50, that'll be a very big negative. It'll say, no, not this time. Couldn't make it in the weekly chart yet to a leg B. And so that's quite. Look at the 200-period moving average. Testing in the monthly. Now we're going to a break. I'll be right back. Basil Chapman, flying blind, but I'll be back. Dow's down 97, S&P's down 7.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at directionshares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. As this one-of-a-kind winter comes to a close and spring approaches, it only seems fitting that now is the perfect time for a spring Tiger Dollar sale. For this week only, we're doubling the bonus that we give when you purchase any amount of Tiger Dollars. Normally, we offer a 10, 15, or 20% bonus when you purchase Tiger Dollars, but for this week only, we're doubling our special offers, and you can now get up to a 20, 30, or even up to a 40% bonus on your Tiger Dollar purchase. This is one of our best Tiger Dollar sales of the year and won't be around for long. Tiger Dollars can be used for any TFNN product or service and provide a great way to lock in added value on your subscriptions. Tiger Dollars never expire, so whether you're a current subscriber or plan on subscribing at one point in the future, take advantage of this spring Tiger Dollar sale this week only and get up to a 40% bonus on your Tiger Dollar purchase. This sale ends Sunday night, so don't miss out. All the details are on the front page of TFNN.com. Get your Tiger Dollars today and lock in your bonus before this sale passes you by. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartley's, butterflies, ABCs, and Fibonacci in order to trade these markets. Trade what you see. Next on TFNN.
Folks, yep, we're back. Just telling my engineer to bring me out from this with the final segment closing chords. So this is what we wanted to do here. I'm looking at the VIX index. The VIX index said that there was a chance the other day to have a rally, but it was really based on my Chapman wave short-term, I call it my Chapman wave trend gauge, had flashed a signal. And that's really what kicked in. Now it's the exact opposite. There is total denial in the VIX index and only up 2 cents, up 0.13. Yes, the S&P is not as bad. It's down 0.37. The Dow is down 0.55. But the VIX should be up at least 25 to 30 cents right now. The QQQ series is also down. It's down 0.30 something, 39. Something's going on. People have no fear at this particular point. And that says to me one of two things. Either the VIX is 100% correct because it's saying, I have no fear because the smart money is not piling in, because they feel very confident that whatever the Fed says, the market is going to go higher. My interpretation says, when the VIX moves from here, if in fact there's a negative interpretation of what the Fed's done, and we might find that the market will come back just about at 1:30 to 2, we'll come back to like down minus 35 or something like the S&P, maybe even positive. It's afterwards. It's not even at 2 o'clock. It's 2:35, 2:36. In fact, for my opening call, for my Traders Corner, I have something very specific for 2:36 if certain things happen. But what's really interesting at this particular point is that if the VIX is correct to say, why are you getting upset? Don't, this is nothing. I'm going back down to the 14s and the 12s. I'm saying to myself, that's not quite the reading that I have, because I'm looking at the different instruments and they are towards the lows, and that's a little unusual. And if there is a move and the Dow at 245 is actually back down minus 80 or minus 60 and more, and the S&P this time is with the Dow and is down minus 7 or more, that's going to suggest to me at that point, then focus on the volatility index. And if the volatility index starts to rise into the 16s, that's when you're going to get the kicker for the downside. If the VIX index instead just says, oh, ho-hum, I'm at 1567 right now, I'll be at about 1530 when the Fed is done with all their stuff, that's going to be saying there is enough buying pressure, because a low VIX is really what I consider to be buying pressure, to be able to sustain a move. And that's the only time, the only way I can see that the SPX.X can go to that leg D above 2119.59 now. Almost everything I'm looking at technically and in almost every way is saying, unless there's a spike about a plus 80 towards the close, or at least by tomorrow you have to be up very strongly, there's a good chance that the pullback has begun, that in fact we're looking at through, especially if I'm looking at the Dow, all those different charts. I don't have time to do it now, but running through all the different indices, the different stocks within the index, there are some really poor-looking stocks. All right, folks, we'll know in a couple of hours' time. Have a great day. Stay tuned for Larry Pesavento. Should be a wonderful show as always. Got a program right here. Hey, don't forget.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.